This is a very challenging topic. I'm going to try to summarize 200 years of business cycle theory and then talk about the application of the theory I favor to the global financial crisis of 2007 to 2010, with emphasis on the United States because that's the case I know best. But I've got some diagrams, so let me apologize for those now. I'll try to walk you through them when they appear. But I'm going to start in somewhat the way that Diana did, with giving props to Paul Krugman for being a forthright, outspoken economist who's wrong about some things. So he provides us with a useful counterweight or foil. He's not a historian of economic thought, but he sometimes plays one in his column. And here he's saying that before Keynes came along, there really wasn't any explanation for business cycles. And if I wanted to be fair to him, I would say probably what he means was no explanation that he, Paul Krugman, likes. But he makes it sound like economists just turned a blind eye to the fact that they were living in the Great Depression and didn't try to explain what was going on. But there were lots of economists at the time who tried to explain what was going on. Actually, long before Keynes published a general theory in 1936, there were already lots of theories contending to try to explain the Great Depression. So I'm going to focus on the theories of Mises and Hayek, in particular Hayek's version of the theory. Since they were from Austria, it's sometimes called the Austrian theory of the business cycle. But you don't have to be from Austria to think it's useful. Lionel Robbins wrote a book entitled The Great Depression, a British economist who adopted this account. Other British economists, Robertson, Hawtrey, Pigou, there was a school in Sweden who had their own take on it. And in the United States, Irving Fisher was the best-known economist who was trying very hard to explain the Great Depression. He was especially trying to explain the Great Depression because it wiped him out personally. In 2 weeks before the stock market crashed in 1929, he gave a speech in New York saying, "I think stock prices have reached what I think is a permanently high plateau. I don't see them falling anytime soon." And he borrowed a lot of money. He bought stocks on margin because they'd been going up and up, so he expected the trend to continue. And he was wiped out. He had to sell his house and move in with his sister-in-law. So he was desperate to find an explanation of what had gone wrong. So here's your roadmap to different approaches to business cycle theory. And this is about as small as I can make it. But I'm identifying sort of four traditions that continue to slug it out. So by focusing on one school of thought, I'm going to talk about the contrasts with other schools of thought, but I'm not going to also have time to fully explain what the theories of the other schools are. But there's a tradition stemming from the Swedish economist Knut Wicksell, and his focus was on when the interest rate gets distorted, when the market interest rate doesn't correspond to the equilibrium interest rate, the interest rate that would coordinate intertemporal plans between savers and investors, then the economy gets out of whack. And he had three groups that followed him, developing this theme in different ways. The group in Sweden that I mentioned before, the Austrians. And at Cambridge, Keynes, in his early book, Treatise on Money, tried to tell a kind of Wickelsian story. That story about interest rate going wrong drops out by the time he gets to write the general theory, and there he completely rejected that mechanism and became more influenced by a second line of thought, which I call underconsumption. It's sometimes called overproduction. Same idea. More is being produced than is being purchased, and that causes the crisis. So the emphasis is on insufficient demand. There's not enough demand to buy everything, and so the treatment is pump up demand. In the quantity theory tradition, the business cycle was described by Irving Fisher as a dance of the dollar. So it's a monetary phenomenon, and Fisher's emphasis was the effect of money on the price level. So the business cycle is a case in which the price level hasn't quite adjusted quickly enough to clear the market for money balances. And that tradition is picked up by Milton Friedman and becomes a monetarist approach to macroeconomics, which has a big impact in the 1970s and 1980s, and has a legacy in current thought. And then the fourth group that I have in parentheses, because early on, I mean, back before 20 years, how far do I want to go back? Before the 1970s, let's say, nobody thought of general equilibrium theory as a business cycle theory. It was a theory of how the economy is perfectly coordinated given certain stringent assumptions. And how could you take that and explain how the economy gets discoordinated or goes through cycles, goes through periods of underemployment or periods of unsustainable booms? But the techniques coming from general equilibrium theory have been used by modern theorists to try to make the stories that they get from Keynes or Friedman more rigorous. So Keynes's followers in the current era can be divided between the kind of old-style Keynesians like Paul Krugman, who basically has the same view that I learned in college in the 1970s, and what are called new Keynesians, who try to provide some microeconomic underpinnings to the idea that there's an underemployment state, that wages don't adjust promptly to clear the labor market, that prices don't adjust promptly to clear the market for raw materials and capital goods. So price stickiness is what the new Keynesians are about, trying to make sense of price stickiness. But there's a second approach which has become known as new classical, which says we don't need to talk about price stickiness or market imperfections. We can explain a cyclical path in the economy just by appealing to real forces in the economy or to the working out of monetary shocks. So Robert Lucas, who got a Nobel Prize for this work, provided a monetary shock theory, but working through a general equilibrium model. Ed Prescott, who shared a Nobel Prize a few years later, developed what's called real business cycle theory, or RBC, where money is not considered the problem or the loose joint in the economy. There are just real shocks, productivity shocks, that affect the economy. And so business cycles, to Prescott, are a phenomenon, but they're not a problem. It's just the economy tracing through its equilibrium path, and there's nothing you can do to fix it. That's just the way things are. You have good periods and bad periods, but stuff happens. It's not anything that calls for policy. Kind of a compromise among these groups has been reached in the formation of dynamic stochastic general equilibrium models, or DSGE models, where you have the techniques of general equilibrium theory, all markets clear in all periods. But you could have them in the flavor of new Keynesian models with price stickiness, in which case markets don't all clear, but because there are costs of clearing them. Or you can have them in a monetary shock flavor, although that's kind of fallen out of fashion. Lucas himself has given it up. Or you can have them in the new classical version where it's all optimal adjustments to real productivity shocks. So I find myself, since I think monetary shocks are important, in this debate, I'm on the Keynesian side, or what's called the Keynesian side, thinking the monetary shocks are important because the economy doesn't instantly adjust. Whereas the real business cycle people say, no, what the central bank does doesn't have any real impact. It doesn't matter for explaining business cycles. There's a kind of moderate position which Lucas has taken, that for most small business cycles, monetary policy isn't the explanation. We can explain those just with productivity shocks. But for the Great Depression, you need to appeal to what the monetary policy was doing, what the central bank was doing, and for the Great Recession. So in the big cases, the big business cycles, the big recessions, there you need to bring in the role that money plays. So I'm going to focus on a theory in which monetary policy does play a big role. And this theory is developed as a way of explaining the Great Depression, which is, of course, the biggest of the big. But I think it's also relevant to the Great Recession. And it's come back into fashion a little bit. More attention has been paid to Hayek and his views than was paid previously. And some mainstream economists who are working in the DSGE tradition have started to say, you know, we didn't predict this crisis, so maybe there's something wrong with our model. Maybe there's something it's missing. And what it's missing is the phenomenon of credit and money being important. So maybe we need to figure out a way to give them the power to be disruptive, because that's what we seem to observe. Guillermo Calvo, who's an important contributor to this tradition, recently published a paper in which he said that. Okay, so as I said, I'm going to focus on the modern version of the Mises-Hayek theory, which has been developed by Roger Garrison, and I'm going to borrow some diagrams from his book. So here's the first tradition I want to focus on. Credit, you can call them credit cycle theorists, but these are people in the Wicksellian tradition, and in particular Mises and Hayek. But you could find antecedents to Wicksell. Wicksell, in many ways, was trying to restate the business cycle theory that came out of the debates in the 1830s and 40s over what was causing business cycles. So these are the first important debates in economic thought. And they're about whether the Bank of England was making the business cycle worse. And Robert Torrens and James William Gilbart tried to explain how it was doing that, how the Bank of England, having a quasi-central banking position, had enough influence that it could artificially cheapen credit, but the prosperity that created couldn't be sustained because the artificially cheap credit couldn't be sustained. And that theme is picked up by Wicksell. Wicksell is most famous for drawing the distinction between the market rate and the equilibrium interest rate, or what he called the natural rate. This phrase, the natural rate, is later picked up by Friedman to talk about the natural rate of unemployment and the natural rate of output. Right? But the idea is that there's an equilibrium interest rate that would coordinate the economy, but the central bank has the power to make the market rate diverge from that. And then you get trouble. You get people responding to a signal that's misleading them. So that's the theme that Mises picks up, and Hayek elaborates it in more detail with regard to what happens to the productive structure in the economy, how investors respond to the distorted interest rate in ways that have real consequences. So that's what I'm going to elaborate. But first I want to give you some evidence that there really is something to explain here. So this is a diagram I took from a paper by Lucas. So this is just real GDP in the US, so this is output adjusted for inflation, versus a trend line that's been fitted through it. And Lucas fitted it in some very sophisticated way. But what you can see is that there's a boom in the 1920s. Output is above trend for many years. And to credit cycle theorists, that's evidence that the central bank was overstimulating the economy. Or sorry, that's something that needs to be explained, and the way it's going to be explained is by the central bank overstimulating the economy. You have to actually look and show on the central bank's actions that they did that, but they were holding interest rates too low is the basic problem. The economy crashes, and you can see the Great Depression is, many orders of magnitude bigger than any of the other deviations from the trend line. So that's the big event that needs to be explained. There's also a little bump above trend after World War II. That's just measurement error. Pay no attention to that. Okay. I could explain, but it's not worth it. So here's the theory in a nutshell, and then we'll get down to more details. If you have cheap credit, then it makes investment more attractive. And if the problem is that the interest rate ought to be rising because there's genuine investment opportunities that are increasing demands for loanable funds by investors, the interest rate ought to rise so that you don't over-deplete the amount of savings, the resources that have been saved to embark in too much investment. But if the central bank steps in and provides paper credit so that everybody who wants to invest now can invest at the old interest rate, then you over-amplify what would have been just a positive productivity gain to the economy into too much investment. When it becomes clear that all the investment projects that have been initiated can't be completed profitably, and in the Great Recession, we saw this in the form of half-finished housing complexes. So they were started when interest rates were low and demand for housing was high, but they couldn't be profitably completed, and in some cases they were just abandoned. So in those years, like right after 2007, if you flew into Las Vegas, which was one of the boom cities, you could look out the window of your airplane and see new developments where streets had been laid out and foundations had been dug and then nothing built on the foundations. And they just sat that way for a while. Las Vegas is now recovering, but there's sort of visual evidence of interrupted investments. So when the crisis comes, when everybody can't complete their projects profitably, the symptom is businesses are going bankrupt. And then you have a period where the resources have to find other uses. Right? If you're making losses, you can't go on doing that forever. So the term for that, for reorganizing, selling, workers going somewhere else, construction equipment going somewhere else, or being scrapped if really necessary, is liquidation and restructuring. This term liquidation has acquired a kind of negative connotation, but liquidation doesn't mean that things are melted down. Doesn't mean that. When an airline, a bankrupt airline is liquidated, it doesn't mean that planes disappear. It means the planes are auctioned off and somebody else buys them, somebody who knows how to use them more profitably. The pilots don't disappear. They get jobs working for some other airline. So liquidation doesn't mean that resources disappear. It means they have to find new owners who have better uses for them. So that's a healthy thing. And one thing that this theory that focuses on mistaken investment or malinvestment helps to explain is why the cycles are most severe in the heavy industries as compared to the retail sector. Right? So retail sales don't vary as much over the course of the cycle as production in the extractive industries, places that make machines that are used by other factories, companies that produce producers' goods, heavy equipment, that sort of thing. That's a kind of stylized fact that the Austrian theory explains that other theories have just kind of put aside and not tried to explain. And in the last cycle, it was the housing industry. Housing is a very time-intensive kind of investment. Right? It takes a long time to pay back, and interest is a very important factor in how much housing you want to buy, what interest rate you can finance it at. So that's where the cycle is most dramatically impacting economic activity. Now there's an analogy that's been attached to this theory. Krugman likes to ridicule it, but there's some truth to it. So it's like the boom period, which is being artificially spiked or stimulated, is like binge drinking. Or somebody spiked the punch bowl at the party, put some alcohol in it that you can't really taste. So everybody's having a pretty good time. But the next morning, they feel awful. Well, that's like after the crash, people realize they didn't behave in a way that they want to keep behaving. And the solution is not to drink more whiskey for breakfast. It's to sober up. Yeah, question?
I didn't understand why in the first place we had cheap credit policy.
So now we're asking, why did the central bank do something that turned out to be mistaken? And I'll talk about that more, but either they deliberately were trying to cheapen credit for political purposes, because it was going to help somebody get reelected or something like that. That's one possibility. Another possibility is they didn't intentionally do it, but they saw more demand for credit starting to push interest rates up, and they said, oh, we don't want that. That'll kill the economy. So they keep interest rates at their old level, which the central bank doesn't think of as doing anything dramatic. But by doing that, they enable more and more investment to be financed, which, if interest rates had risen, the brake would have been put on more appropriately.
Is that what's happening now with that zero interest rate policy?
So now we've had zero interest rates for a long time, and many observers, including someone in the Federal Reserve System, have said, by all measures, it's long past time to raise interest rates. Why haven't they done it? Political pressure, I would say. They would rather overstimulate than understimulate. There's a kind of asymmetry there. So they'd rather err in that direction. That seems a common view among central bankers. This analogy of binge drinking and hangovers to what happened in the last recession actually became so common that President Bush picked up on it. And he was speaking at a fundraising event, I think it was, after dinner, and he said to everybody, okay, turn off your, somebody asked him, explain to us what happened in the financial crisis. And he said, okay, you have to turn off your cell phones and your recording devices. And of course, not everybody did, so we know what he said. He said, Wall Street got drunk and now it has a hangover. So he was basically, in a simplistic way, picking up on this idea that, but why did Wall Street get drunk? That's what we have to ask. And this theory says the central bank spiked the punch bowl. Right? If people are acting crazy, you want to know who gave them the crazy juice. Okay, here's where the diagrams begin. So the first diagram is very simple. If you're an economics major, you've seen it before. It's a production possibility frontier. If you're not, the basic idea is if we divide everything in the economy between consumption and investment, then there's a trade-off. This sounds pretty simple. So really all it's saying is, think of a simple economy where the good is corn. You can either eat the corn or you can save it and plant it so that you have a bigger crop next year. That's investment. Right? But you can't use it both ways, one or the other. That sounds pretty simple, but it's actually a dagger into the heart of Keynesian economics, which says that consumption and investment go up and down together, always. You only get more investment if there's more consumption spending. If consumption spending flags, then investment will flag. Right? But this is saying, no, there's a trade-off between the two. So what governs how much consumption there is versus how much investment there is? Well, it depends on the rate of return to investment as compared to the cost of financing the investment. The cost of financing the investment is the interest rate. Right? So where's the interest rate determined? The interest rate is determined in a market for resources. You can either use the resources for consumption today or for embarking on investment projects. So think about labor. People can either work in the retail sector or in the service sector where they immediately are providing services to clients, or they can work in a factory producing trucks that go to other factories to do other jobs that are fairly remote from final consumption. Eventually something's going to get produced because that's what is going to pay the bills in the factories that are producing inputs into other factories. I'd say a steel factory is pretty remote from final consumption. This is the market in which the interest rate is determined. The supply of loanable funds comes from savers. So we've got an upward sloping supply curve. At a higher interest rate, people will be willing to save more to forego consumption because they get a higher return by foregoing consumption. So So you get an upward sloping supply curve. You get a downward sloping demand for loanable funds coming primarily from investors. So I'm leaving out governments as demanders of loanable funds. I'm leaving out the rest of the world. Just think about a domestic market in which households are providing the savings and business firms are demanding those savings. But at a high interest rate, there's not going to be as much demand because you think of the project has to repay your loans. At an interest rate of 5%, you're not going to finance any project that pays less than 5%. So if you lower the interest rate, more projects are now worth financing. The ones that pay 4.5% are now worth doing when the interest rate is 4%. So you get a downward sloping demand curve. And there's an interest rate, the one with the hollow dot here, corresponding to I sub EQ. That's the equilibrium interest rate. That's Wicksel's natural rate. That will coordinate the plans of savers and investors. Savers won't be frustrated. There's somebody who wants all they want to save at that interest rate. And investors won't be frustrated. There's somebody supplying savings to the extent they want them at that interest rate. So that's the equilibrium interest rate. Now, if we want to introduce some change in the story, and the only reason you ever draw supply and demand curves is so you can shift one of them and see what happens. Suppose there's an increase in voluntary savings. Suppose the public becomes more thrifty for whatever reason. That will make more savings available at any given interest rate, so you have to redraw the curve farther out. As the interest rate falls, because there's a surplus of funds at the old interest rate, savers can't find anybody to take the funds from them, so they start agreeing to take a little lower interest rate. The interest rate falls to the dark circle. That's the new equilibrium. Right? So an increase in savings lowers the interest rate. People become more thrifty. They're willing to accept a lower interest rate. And you'll get a higher volume of investment at that rate. But if all this savings is actually voluntary, people are willing to forego consumption for the time being. They're saving up for something in the future, but for the time being, they're willing to sacrifice consumption and save more. Then the investment can be successfully financed through to completion. And eventually, there'll be more output in the economy and more consumption. That's the point of the saving, after all. But in this short run, there's more investment, and the investment can all be successfully completed. Now, I need one more diagram to show what's happening with the investable funds. So I put the first two together. If we have more loanable funds available through voluntary savings and that lowers the interest rate, the quantity of investment increases in the lower diagram. We can take that higher quantity of investment and bounce it through the consumption investment trade-off, the production possibility frontier, and there we get the gray arrow representing the movement from the old equilibrium to the new equilibrium. That's why that arrow was there all along. All right, so it's a reallocation of resources. The price signal being provided is a lower interest rate, and it's coordinating savers with investors, so everything's good. With a greater volume of investment at a lower interest rate, certain kinds of investment projects are going to be most affected by this cheaper availability of financing, namely the projects where interest is a bigger part of the cost. And those are projects that have longer payback periods. If you know any basic finance, right, you know that a payoff that's 30 years in the future is much more affected by a change in the interest rate at which you discount the cash flow than a payoff that's a year from now. That's hardly affected, but you compound the interest for 30 years, you get a very powerful effect. So there's going to be an increase in long-term investment, or what the Austrians used to call roundabout investment, projects with long payback periods, relative to investment in retail or short-term projects. Actually, investment in retail has got to go down because consumers are consuming less. There's less spending on final consumption goods. Here's a fairly technical diagram making the point that investors are going to go for longer payoff projects. Let's see if this is worth going through. So this curve that goes from the letter Q up through Q sub theta, think of that as the value of the investment project at different points in time. So time is going from left to right, and value is going from bottom to top. Value in the sense of the market evaluation of the worth of this project. Think of it as a growing tree, right? So on day 0, the project has a negative value because you spent money to plant the tree, but you don't have any harvestable lumber yet. Over time, the tree grows, and it grows at a rate that accelerates for a while and then starts to slow down. When do you harvest the tree? You harvest the tree when the rate at which it's growing equals the rate of interest you could get in the bank. Because if the tree's growing at 5% and you could only get 4% in the bank, then let the tree keep growing. If the tree's growing, it slows down and is growing at 3% when you could get 4% on money in the bank, cut the tree down, sell it, put the money in the bank, and you'll get a higher return than leaving it in the tree. Right? So this shows you when it's the best time to harvest. And it's an analogy for when it's the best time to, how roundabout, how time-consuming an investment project you want to engage in. So the steepness of these straight lines indicates the height of the interest rate. Right? It's the rate at which value grows over time. So at a high interest rate, P star is the optimal time to end the investment. But at a lower interest rate, you want to keep the investment. Right? So I said at 4%, you cut the tree at P star. If the interest rate drops to 3%, then if the tree is still growing at 4%, you don't cut it yet. You let it grow for more time until the rate of growth slows down to the market interest rate. So more roundabout investment. Now, these kind of natural growth, agricultural, forestry examples have been popular in investment theory for a long time. But you can talk about other examples that involve more familiar kind of investments. So I talked to somebody once who built condominiums. And he said, when interest rates were really high, we couldn't afford to tie up our money for very long, so we built one-story condominiums. It took more land to create the same amount of housing units, but land was cheaper than interest. To build a two-story condominium, it took longer. Right? You get more housing space per unit of land, but you pay more interest. So when interest rates are high, it's not worth it. Stick with the one-story condo. When interest rates were low, we switched to building two-story condos. Right? So it's a more roundabout investment when the cost of making a more roundabout investment, a more time-consuming investment, has gone down. Right? So there's substitution at the margin when the costs change. Okay, Hayek drew this diagram sort of giving a picture of how the value of investment grows over time. And the horizontal axis here is labeled stages of production. And the basic idea is pretty simple. Think of the really early stage of of gasoline production as the extraction of oil from the ground. That's the first stage. And then somewhere in the middle is refining. So it takes a while to get the oil out of the ground, ship it to the refinery, have it refined. And then it goes to the retail level, so there's the gas pump. That's the final stage. And so that's a kind of folksy example of what we mean by stages of production. But this diagram actually serves a kind of double purpose. You could think of it as a snapshot of what's going on in the economy at a point in time. At any point in time, there's so much of the economic activity is involved in early stage production, so much is involved in intermediate stages, and so much is involved in the retail stage. And the proportions between them aren't fixed. The proportions between them will vary with the interest rate, with the time value of money. We don't do a very good job of measuring activity in earlier stages of production with current statistics. We measure consumption. That's part of GDP. We don't measure this other stuff. And so it tends to be ignored by economists who are driven by what the data makes readily available to them. So let's simplify from many, I wanted to say the diagram serves another purpose, which is instead of think of it as a snapshot of the entire economy at a point in time, you can think of it as the life history of a particular output, like say gasoline. It goes through various stages of production, and while it does, the value grows. Right? Gasoline is more dollars per gallon than crude oil is. Value has been added at the intermediate stages of production as it's refined and as it's shipped to where it's going to be consumed. All right, we can simplify that set of bars into a simple triangle. And now back to our thought experiment: more savings, lower interest rate, more investment, less consumption. So the triangle has to get shorter at the consumption end. People are saving instead of consuming that much. And it lengthens from right to left because there's more investment, so that if it's not at the retail level, where is it? It's at earlier stages of production. And in this way of drawing it, early stages of production have been added. That is, investments have been undertaken that will take longer to come to fruition, that weren't even engaged in under the higher interest rate regime. Right? So you get more capital intensity in the production process. Right? Capital is bottling up resources for later payoffs, and the willingness of investors to do that depends on what it costs them. And what it costs them is the interest rate. Okay, so the title says sustainable growth from additional savings. So you can't really see the growth here because this is a snapshot at a point in time. To show the growth, you need an animated slideshow. And Roger Garrison has one of those, but I felt bad about stealing that too. But what's going to happen over time is that the production possibility frontier is going to move out. More investment means it's possible to have more consumption in the future for any given level of investment. And so the whole production possibility frontier shifts out over time. And the more saving the economy has, the faster it grows. Right? So you just have to imagine the animated version where that happens. So that's great. That's intertemporal coordination between the plans of savers and the plans of investors, between consumption today and consumption in the future. That's what's intertemporal about it. And the coordination is driven by the price system, in particular the interest rate. Right? So that's the job the price system is supposed to do for us: coordinate suppliers and demanders, and in this case, suppliers of present resources who are demanding future payoffs. But here's where you have problems. You have problems if the interest rate in the market is not accurately reflecting the preferences of savers and investors. So suppose the supply of loanable funds shifts, but now not because savers are more willing to save at any given interest rate, but because the central bank decides to lower the interest rate. This is the easier story to illustrate, but empirically, I think the more relevant story is one where, as I said earlier, there's more investment demand, so the demand for loanable funds shifts to the right, and the interest rate should go up, but the central bank holds it constant by shifting out the supply of loanable funds. That's a more complicated diagram, and it's harder to show what happens in the structure of production. So let's do the simple case first. All right, so the interest rate goes down again, but now it's not accurately signaling that savers are willing to forego consumption, because they aren't. And in fact, at a lower interest rate, people don't want to save as much. So you're going to get more investment because interest rates are lower, but you're actually going to get more consumption too, because there's less reward for saving. Right? The central bank has driven a wedge between the plans of savers and investors. So that's going to be reflected in the production possibility frontier. So look at diagram 2. At the lower interest rate, investors want to invest more, so that's the dot lowest on the production possibility frontier, investments on the horizontal axis. So more investment is desired by investors. At the same time, more consumption is desired by consumers. So from the black dot, go northwest, and you see where consumers want to be. So there's more demand for consumer goods. At the same time, there's more demand for investment goods. And in any economy, just as a normal phenomenon, there's a certain amount of slack, which makes it possible to increase output of both things for a while. So take the vector of forces. It's the white circle, the empty circle to the northeast of the black equilibrium point. Right? So the economy is tugged in that direction. More consumption, more investment. The economy actually goes outside, above, and beyond the production possibility frontier. Right? That's the boom. That's the economy being more than fully employed, where fully employed means you have the normal amount of people between jobs and idle machines. You can actually go have more employment than that because you can reduce the number of people unemployed by hiring people out of that pool. So the unemployment rate goes down. And you can take machines that were previously sort of put aside because they operate at higher costs, they're obsolete, and put them to work. And of course, you can always work overtime. Yeah, question? No. So there is, you can have overfull employment, you can have the economy producing above the long-run sustainable production possibility frontier. There's a sports analogy here. People sometimes ridicule the coaches of sports teams for saying, my team gave 110%. How can you give more than 100%? That doesn't make sense. Well, for a while you can. The coach can tell the team, go and give 100%, 110% for the next 10 minutes, which means harder than you could keep up for the entire game. And it's going to be reflected in the team being worn out at the end of the game, but for a time period, for a short time, you can do it. So that's what the economy is doing here. It's overstraining its resources. But that can't be sustained because people took these jobs, got hired out of the pool of the unemployed, and because they thought the wages were higher, that were being offered were higher than they really are. Employers laid fewer people off because they thought they were making profits that were actually higher than they turn out to be. And the way Garrison draws it, you get consumption peaking and beginning to fall, investment, then you get the farthest to the right you can, investment starts to fall. And in the crisis, the economy moves inside the production possibility frontier. So that's the deepest part of the recession, where you clearly have less employment and less employment of not only labor, but of capital goods, of machines. So you get unemployment, you get idle capacity, and it takes the economy a while to recover from that. And so what's happened? Workers and machines were drawn into employments in the early stages of production especially that aren't viable, that can't be sustained. So in the US, in the last boom, they were drawn into the housing industry. Tremendous boom in the housing industry, more workers become construction workers, more machines go to work on construction sites. Now it turns out that was a mistake. What happens? The workers are laid off. It takes them a while to find the next best use of their labor. Right? People search for a job. They don't just take, construction workers don't just go to work at McDonald's. So you get a bulge in unemployment, and the same thing, you get a bulge in the usage of plant and equipment. You get a drop-off. Yeah?
I just want to make sure I'm reading this right. So on the top right, the consumption investment curve, so you have a top left white dot.
Yeah.
That's the highest point of consumption on the graph.
Right.
Per se. So is that what the correction should do, which would then drop investments and savings, and it doesn't happen, or?
So the only sustainable point is the black dot.
Okay.
But consumers are over-consuming, you might say.
So the white debt outside.
So they're pulling in that direction. That's what the white debt. So the vector, the two poles, is to the northeast. So the consumers are pulling up, and the investors are pulling to the east.
And then you're saying there's never a correction from the northeast point to the northwest point and down to job savings and investment.
Well, it could turn either way, but just for illustrative purposes here, it's drawn that consumption peaks before investment does. That's an empirical question. But in the last recession in the U.S., I don't know if you had the same thing here, lots of big retailers went belly up. People had been thinking they were wealthier. House prices were high. People were borrowing against the equity in their house to remodel, to buy new appliances and furniture. Appliance retailers went belly up. Circuit City, Linens and Things, I don't know if these names mean anything to you. Big retail chains went bankrupt when consumers said, oh, we need to delever. We've taken on more debt than we really can sustain now that we see our house isn't really worth what we thought it was or what the market was telling us it was worth a year ago. In the stages of production, the attempt to consume more is drawing resources into final stages of production to provide more consumption goods immediately. The cheapness of the interest rate is drawing resources into the earliest stages, but there aren't enough resources to do both of those things. And the jagged lines sort of indicate that this can't really be completed. It's not sustainable. Now, there's a lot of free parameters here. This is not sort of being rigorously derived, but I'm trying to give it a kind of intuitive telling. So you get a boom followed by a bust. And that's the pattern of the Great Depression that this theory was designed to explain. That's the pattern of the recent boom and bust, especially in housing, and then followed by the collapse of housing finance. So this is the same thing I just said, just to make sure I didn't leave anything out. Cheap credit, false boom, crisis, liquidation, crisis most severe in producers' goods industries. In the recent boom, it was housing, and in the crisis, it was housing, of course. In the Great Depression, it was heavy industry. There were genuine investment opportunities in the 1920s. Automobile industry was just taking off, electrification, electrical appliances. That was all new, but it got overextended, and the companies that really crashed were pig iron production, steel production, electrical utilities, that sort of thing. So it's like a hangover after the binge drinking. Another way to look at it is to say, why were there so many mistaken investments? Why was there such a cluster of entrepreneurial error? And the answer is, normally people are correctly oriented by the price system. Normally following price signals and pursuing opportunities to buy resources and sell them after transformation at a higher price, if the signals are correct, then you do make profits, or you make at least a normal rate of return, and the investment is sustainable. But here the signal was being given that investment was cheaper than it really could be given the savings preferences of the public. Because the central bank messed up with the signals. The central bank lowered the interest rate, whether intentionally or not, below the equilibrium level. And how did they do that? They did that by expanding the money supply and the credit supply faster than savers really warranted. Okay, so that's the Austrian theory in a nutshell. It wasn't the only theory at the time, although it was a leading theory. And in the early 1930s, Hayek was Keynes's leading rival as whose explanation do we accept. Keynes started writing early on, around 1930, that the problem in the Depression was lack of demand from investors. Up to 1929, everything was great. So he didn't see any problem with the boom. didn't see that it was unsustainable, thought the economy was doing great. But somehow investment dropped after 1929. And his explanation was investors lost their nerve. For no good reason, just a mood swing. Animal spirits, he called it. Well, that seems to me to call for some further explanation as to why there's a swing in animal spirits. Why did investors suddenly become less bullish? If you can't appeal to some kind of fundamentals, then it's not a very satisfactory explanation. Milton Friedman, in retrospect, had a different explanation of the Great Depression, been very influential, which is, like Keynes, he thought everything was going fine in the 1920s. There wasn't any problem building up, didn't see a bubble building up. But the money supply started to collapse after 1929. Now, the timing's not quite right here. The recession started in the middle of 1929. The US money supply didn't start to collapse until the middle of 1930. And it collapsed because there were bank runs. And there were bank runs because businesses are going belly up and they're not repaying their loans to the banks, and the banks are insolvent, and so the customers were running on the banks. So that doesn't really explain why there was a downturn. I think it does help explain why the downturn went even deeper than it needed to correct the mistaken investments. But it's not really an explanation of why the boom didn't last beyond 1929. Friedman and Hayek were good friends. They were both members of the Mont Pelerin Society, which is an international society of classical liberals. And so Friedman never in print directly attacked Hayek's theory, but he did it in an interview in 1999. And this argument has been repeated by many Keynesians because it seems to favor Keynes over Hayek. Right? So what he says is, I think this theory has actually done the world a great deal of harm. Because if you go back to the 1930s, you had the Austrians sitting in London, Hayek and Lionel Robbins. So Hayek and Robbins both taught at the London School of Economics. Hayek had come from Austria and taken a job at the London School of Economics. And they were pushing Hayek's theory of the business cycle and saying you just have to let the bottom drop out of the world. So Friedman is taking the advice that comes out of the theory, which is you've had mistaken investments. You've got to fix that. You've got to not perpetuate the bad investments, but let the resources be reallocated, the liquidation and restructuring. That's what Friedman is calling just let the bottom drop out of the world. You've got to let it cure yourself. You can't do anything about it. You'll only make it worse. This is a little bit puzzling coming from Friedman because that's what Friedman believes. If somebody makes a mistake in investment, don't perpetuate it, correct it. I think by encouraging that kind of do-nothing policy, they did harm. So Friedman's concern is that the money supply was shrinking. He doesn't say it in so many words, but that's what his concern was. And Hayek and Robbins weren't saying the central bank needs to keep the money supply from shrinking. And there, I have to concede he has a point. It actually follows from Hayek's own theory that you don't need additional contraction in order to correct the malinvestments. Now you've got if the money supply is shrinking because of bank runs and the central bank is not offsetting that, not acting as a lender of last resort, now you've got an additional blow to the economy which is entirely avoidable, which is the contraction of spending. So there's no reason to go through that pain, that additional pain. And although Hayek's theory called for not going through that additional pain, Hayek called on central banks to actually stabilize total spending in the economy. So if people are hoarding money, the central bank needs to be proactive and provide the money that people want to hoard so they don't have to cut back on their spending in order to build up their money balances. So it's unfair to Hayek in the sense that that's not his theory. His theory is stabilize nominal income. And if you're familiar with the quantity theory and the equation of exchange, MV equals PY, it's a shorthand way of saying one person's income P times Y, the price at which they sell, times Y, the number of units they sell, real income, equals total spending in the economy, which is decomposed into the number of dollars times the number of times per year a dollar turns over. So that's dollars per year on both sides of the equation. If the money supply starts to drop, that'll cut into spending unless it's offset. Or if people start to hoard money so they turn it over less frequently, V is for velocity, then that can be offset by monetary policy by increasing the money supply. And in the fourth lecture of Hayek's book published in 1931 called Prices in Production, that's what he calls for, stabilizing nominal spending in the face of these kind of shocks. But when he wrote op-ed pieces in the 30s, Hayek didn't draw attention to that problem and call for that remedy. He criticized people who were trying to pump the money supply back up to where it had been in 1929, which was unsustainably high. Excuse me. But the end of Friedman's claim that Hayek and Robbins had a dangerous, damaging effect on economic policy is just, he's got the timing wrong. The crash happens in 1929 and the Fed does nothing to stop the money supply shrinking in 1930 and 31. Hayek's book wasn't available yet. He only gave his lectures in 1931 that were published late in 1931. So that can't explain the actions of policymakers in 29, 30, and early 1931. Plus, there's no evidence that anybody at the Federal Reserve was reading Hayek's book. They weren't commenting on it. They had a different theory. Their theory is called the real bills doctrine. And it would go too far into the weeds to explain that, but here's what the picture looks like. And this is what I said was the more relevant scenario of the interest rate being distorted. So, increase in investment demand, demand for loanable funds. At any given interest rate, investors want more because they think they have higher payoff projects than they had last year. Something comes along, electrification in the 1920s, computerization in the 1990s, information technology revolution, housing in the 2000s in the United States. That should drive interest rates up if you want coordination between saving and investment. And then you get an increase in output and investment, you get a boom, but only a sustainable boom. Or you get an investment boom, you actually get a cutback in consumption because it pays more to save now. But here's what the Fed did after demand shifted to the right for loanable funds, and it would have raised the interest rate. The Fed said, our job is to make sure everybody who wants to borrow gets to borrow. The real bills doctrine teaches that the central bank should satisfy the market's demand for credit. Well, at what interest rate? If it's the same old interest rate, that means injecting paper credit to satisfy the demand, but that's unsustainable. So you keep the interest rate from rising by adding money growth to finance loans without the real savings to back those up. So the boom gets overexpanded. That's the mistake the Fed made in the 1920s. It's the same mistake they made in the 2000s. Yeah. So real dollars means resources measured in terms of goods and services. So total output divided by the price level to give you the amount of stuff that we're talking about. So I said there's a different tradition, which is Keynes's tradition. I'm running out of time here, so I'm not going to go deeply into that. But it also has a prehistory, goes back to Engels, of Marx and Engels, who said, well, we have this theory that workers aren't paid enough to buy back the product. They're being exploited. They're not being paid the entire amount they produce. The difference goes to the capitalists. If the capitalists don't spend enough, then there's not enough demand to buy back the entire product, then you have a recession. Unsold inventories, businesses make losses, you have a crisis. And that idea is picked up by J.A. Hobson, in the United States by Rexford Tugwell, who's a chief economic advisor to Franklin Roosevelt, the president during the Great Depression, and picked up by Keynes eventually. And Keynes praises Hobson doesn't mention Engels in the general theory. So you know Keynes's diagnosis. Maybe I can finish here. If you haven't seen these videos, they're quite entertaining. It's Hayek and Keynes in a rap battle. The first one's called Fear the Boom and Bust. Hayek keeps saying blame low interest rates, and Keynes says no, it's the animal spirits. And it's illustrated by Keynes going on a drinking binge and then having a terrible hangover in the morning, whereas Hayek is kind of a stick in the mud. And then there was a sequel called Fight of the Century, which is more about fiscal policy. But the first one is about monetary policy and the argument between Keynes and Hayek about what's responsible for the Great Depression. So why did Keynes' theory win the day? I think Hayek's theory is more compelling, but it's a gloomy theory. It basically says when you've got a recession, that's revealing that you already made the mistakes of encouraging malinvestment, and there's really nothing you can do except let the economy cure itself. Let people go through a period of unemployment until they find better jobs. That's the fastest way for the economy to recover. You don't want to subsidize people to take, well, I shouldn't say you don't want to, but if you subsidize people to take longer to find a job, you're going to stretch out the amount of time it takes to recover. If you try to keep the housing industry alive in 2009, let's say, you're just throwing good money after bad. You're going to slow the process of workers moving out of housing into something more sustainable and material inputs moving out of housing into something more sustainable. So why would you want to do that? Just pull off the Band-Aid quickly. Don't try to peel it back very slowly or leave it there forever. Let me see. So that's technical. Here's Friedman's story. So I want to say something about the financial crisis. Let me take about 5 minutes, and then we'll have time for questions. So I said the boom precedes the bust in the 20s. Here's the more recent episode. Now, to be honest, I just kind of hand drew this trend in. I didn't run a polynomial regression the way Lucas did. But same pattern, you get a period of above trend output before it comes crashing down. And this one is real sales of domestic product, which is GDP minus imports. So it's the same pattern. So we still need to explain why there was a boom that couldn't last. And so I think Hayek's theory is relevant again. I'm not saying it explains all business cycles, because not all business cycles show that pattern. Sometimes you just get a recession and then a recovery without there being a previous boom. Something else has to explain that. Here's the quote from Calvo that I mentioned. He's looking at what's wrong with the state-of-the-art theory. Why didn't it predict or see any trouble coming in the housing boom? He says, I'll argue that we could learn something from the Austrian school. They attributed excessive expansion to central banks' propensity to keep interest rates low to ensure full employment at all times. And low here has to be understood as not necessarily lower than it is now, but lower than the equilibrium interest rate. So when forces are tending to raise interest rates, they try to counteract them. And secondly, an insight from the theory is, and this has to do with what you do in the recession, once credit over expansion hits the real sector, rolling back credit is unlikely to be able to put Humpty Dumpty back together again. So once you've had the crash and the egg is lying on the ground, you've wasted. It's the news that you've already wasted resources. And in the pattern we see since the recession, you see the result of having wasted resources during the boom, namely that output, this is the United States, hasn't gotten back to the old trend. It's just paralleling the old trend. And I take that as a reflection of all the resources we wasted during the boom building houses that didn't need to be built. So quickly, the bubble in housing is partly the responsibility of the Federal Reserve. There's a lot of other things going on. There are a lot of bad incentives in the financial industry that led to reckless behavior. There are regulatory rules that encourage or actually mandate that the housing finance giants, Fannie Mae and Freddie Mac, who are themselves a mistake, they had mandates to engage in reckless mortgage lending. And so that's important to explaining why the extra credit the Fed was creating went overwhelmingly into housing. But if you ask how could there be a boom, it has to be financed somehow. So that's the Fed's role. And Bernanke was whispering in Greenspan's ear, because Greenspan had been relatively good as a central bank governor, as a Federal Reserve chief, in terms of keeping business cycles pretty moderate. The Great Moderation, they called it. But Bernanke became a member of the Federal Reserve Board and was telling Greenspan, deflation is right around the corner. You need to be more expansionary following the dot-com bubble. You need to be more expansionary in the early 2000s. Keep pumping in credit, keep interest rates low for a long time, even after the recovery begins. So the Fed held interest rates too low for too long, and that's what fueled the housing boom. So here's evidence of the interest rate being too low for too long. One commonly used guideline for assessing where the Fed should be targeting the interest rate between banks, that's the so-called Fed funds rate, is based on what's called the Taylor rule. So it's not a constant. It reacts to what's happening to inflation and what's happening to output in the economy, the so-called output gap. But it says that as the recovery was taking place starting in 2002, interest rates should have been raised to keep the economy on an even keel. Instead, the Fed funds target continued to drop until it hit 1%, which at the time was unprecedented. And it was later raised, but rather slowly, so that it remained below where it should have been. So that period where the actual, that's the colored line, is below the Fed funds target recommended by the Taylor rule. And there are multiple jagged lines there reflecting you'd have a different target depending on what inflation rate you were trying to hit. So they range from 0 to 4%. But it's below any of them. So in a way, this is saying the Fed was pursuing a policy inconsistent with even 4% inflation. Then you're entitled to ask, well, where did the inflation go then? Well, it didn't go into the consumer price index. It went into housing. It went into the price of houses. Price of houses is not in the consumer price index. So if the Fed only pays attention to a measure of consumer prices, they're not going to see the evidence that they're being overly stimulative. If you look at the real Fed funds rate, that is the interest rate minus contemporary inflation, it's negative. It drops precipitously, and then it's negative for a lot of this period. So it's like free money. If you borrow at a negative interest rate, then even if you invest in something that just keeps up with the price level, you make a profit. So you borrow, you invest in a warehouse full of toilet paper, you make a profit because the price of the toilet paper will go up while the amount that you have to pay back doesn't go up. Now, government bonds during this period performed very poorly, so some jokesters have said that toilet paper outperformed Treasury paper during this period. But that's what happens in negative real interest rates. Here's the boom in nominal spending. Here's the housing boom. So this is house price index over time. That's the dark line. And the gray line is the amount of credit going to the housing sector. So it's a flood of credit that's bidding up house prices. Here's a different measure of housing prices, but the same pattern. This is the ratio of house prices to rent. So this comes from a paper that has my name on it, although I've never run this regression, but I had a ghost co-author. He was the editor of the volume this appeared in, and he said, I've got a great way to illustrate your argument. And he gives me these scatter plots. And I said, really, you ought to let me put you on as a co-author of the article. He said, no, no, no. So it's weird. In each of the diagrams that he gave me, I've got a credit at the bottom, diagram courtesy of David Beckworth. But he didn't want to be co-author of the article. Anyway, so this is trying to show that the deviations from the Taylor rule, the interest rate being too low, is responsible for the high price of housing. So Taylor rule minus the Fed funds rate on the horizontal axis, house price to rent ratio, one measure of house prices on the vertical axis, or house price to personal income, and the two match. So the periods where house prices were really high are the periods where interest rates were really low, not in absolute terms, but relative to where they should have been according to the Taylor rule. And what's fueling this? It's growth in bank credit, which is reflected in the monetary aggregate M2. M2 is the sum of all bank deposits plus currency held by the public. And if bank deposits are going up, so are bank loans. So here's where the U.S. economy is now. This is a sort of blow up of the picture we saw earlier. There's a decline in real output during the recession, and then the recovery has just kind of paralleled the old trend without catching up to it. So it's been an extraordinarily weak recovery. And I think the recovery's been prolonged by all the policies that have been meant to make it less painful. But by making it less painful, they've made it slower for these resources to be reintegrated. Everything the Fed has done to try to keep the price of housing up has slowed the recovery. So, big summary, monetary policy matters because it determines the inflation rate, of course. That's the sort of long-run effect. But there's a cyclical effect. Bad monetary policy can amplify business cycles. In the US, the Fed has a dual mandate to worry about real variables, not just the inflation rate. And that's been sort of the fact that they're worried about unemployment or real output relative to trend is what has led them to pursue low interest rate policies. I skipped through that. That's sort of Fed history. How do we get better results? Well, if the central bank is part of the problem, then we need some monetary reform. And here there are lots of possibilities to choose from, ranging from very moderate to fairly radical. So at the moderate end, the Fed could be given, or any central bank could be given more explicit instructions, a rule to follow. Some central banks have a rule, which is an inflation target. An alternative rule, which I think is better, would be a nominal income target. A more radical proposal, go back to the gold standard or something like it. A system under which you don't even need a central bank, and then let markets set interest rates, not a committee of experts. And then you can reprivatize the monetary system in the fashion that we talked about yesterday. Okay, any questions? Yeah.
So, I had two questions. You said that, why did Keynes win, the notion was going on is because Hayek's viewpoint is relatively pressing, I'd say, today.
Right, so Keynes just says there's something we can do, and there's a job for economists. The government's going to need expert policy advisors to pull the levers.
And so, people who I guess are, witted on their job, say, I'll be a Democrat so I can make sure I get that job when it's needed. But is there some human nature says we want to do something? If there's an issue, we want to do something, whether you're hurt in whatever way. Is there a way to take Hayek's viewpoint and still actually do something, not just tell the public we're doing something, but do something practical so people say, oh, that could work because we're doing something, the human nature part, but also the economic end of being responsible.
So if you retain the central bank, you have to give them some instructions. And I said what I would recommend is tell them to try to stabilize nominal income, or another way to put that is stabilize total spending in the economy. But you want to do that in a forward-looking way. You don't want to react to GDP 2 quarters ago. You want to try to anticipate what's going to happen to spending so that the Fed's policy is timely. And that means you need forecasters, and so that gives them something to do, but it also gives us, the public, a way to evaluate whether the Fed is living up to what it's being asked to do. Currently, the Fed makes up its own goals. And if they didn't hit the goal they used to have, they have an explanation as to why they changed their focus. Not that they failed, it's that something else became more important, and that's what we decided to do. So it's hard to hold them accountable, because they're not given an explicit mandate as to how they want to pursue monetary policy. So there's lots to be done there. But in terms of when you're in a recession, activism isn't really what's necessary. What's necessary is to let the price system work. Now, there are obstacles to the price system working that we could, pursue policies to make prices more flexible, to make labor market reform so that labor markets are more flexible. But those are good policies whether you're in a recession or not. Yeah.
How about a small country like Israel, that their interest rate is determined or affected by the, let's say, the US interest rate, but there are cases that it doesn't fit, or that people come here to make a short-term investment and then take the money out?
Yeah, so if you don't have a central bank that can affect the interest rate, then this theory doesn't apply. At least the part of it that says the central bank is responsible for driving a divergence between the market rate and the equilibrium rate. I'm not sure the Bank of Israel is that weak, but they have their own currency, right? So it's true. But even the United States is affected by international interest rates. So some movements in interest rates reflect changes in global interest rates.
But the US is bigger, so they can determine whether the interest rate...
They have more leverage,
to them.
yeah, that's for sure.
And one of the problems that's of short-term investments, they put money in, but then they take it out and they can make a recession or a deflation of a small country.
Well, so when there are short-term capital flows, and this is a problem in the developing world too, that turn around quickly, it's because they don't trust the policy environment to remain stable. That's why the investments are short-term. And when the investments leave, it's because they think the policy environment is about to get worse. The central bank is about to devalue or something like that. And so that makes for hot money flows. And the way to avoid hot money flows is to have a more stable environment. So the outflow of international funds is a plebiscite, if you like. It's a referendum on whether the investors like the government's policy. Now, if you don't want international investors to have any influence on your policy, then, well, I don't know what you do except forego the investment, which, if it's done right, makes the country richer. So you don't want to say no foreign investment. You can put obstacles to it, but then you're going to have less of it. You'll have less machines to work with, you'll have lower productivity, and so on. But even developing countries that have stable monetary regimes, which are few and far between, but the best examples are those that don't try to run their own monetary policy, that have a credibly fixed exchange rate. They don't have that problem. So Panama has been on the US dollar standard for 100 years, 110 years actually. They don't have a problem with hot money flows because there's nothing the government can do to devalue. They don't have their own currency to devalue against the dollar. So you don't have that kind of panicking or nervousness on the part of investors. Other questions? Yeah?
Well, you do say, from what I got, that you advocate for the fixed rate exchange. But the whole world was in the fixed exchange rate. We had the gold standard, and we had all Europe played with it a lot with the snake in the egg. Okay, well, I don't know how it's in English, and other forms before they got into the Eurozone. And every time when crisis hit, they had to make changes. Fixed monetary exchange rate doesn't work. It works perfectly when all the other things work perfectly, but then when crisis hit, it doesn't work.
Well, this is a whole nother lecture, I guess, but you can have good, well-fixed exchange rates with a credible commitment, and you can have poorly fixed exchange rates with a weak commitment, in which case you get speculative attacks against the exchange rate. Or you can have the central bank pursuing a policy that's inconsistent with maintaining the exchange rate, and then you have a crisis. Under the international gold standard, there were countries that had central banks that monkeyed with the gold standard. They were not firmly committed to it, and when people suspected that they were about to devalue, then there's a crisis. In countries without central banks, there was nobody who could devalue. There was never a crisis of that kind. Right? So that's a credibly fixed exchange rate. But in our current world, where every country has a central bank, well, almost every country, not every country, and they are determined to pursue an independent monetary policy, then fixed exchange rates won't work. You have to give up the ability to pursue an independent monetary policy, as the members of the Eurozone have done. And the Eurozone has done well as a monetary union. It has trouble now because they decided to do fiscal policy.
Well, they have problems because some countries did lie about this.
And right, they let in Greece, which simply falsified their numbers to get in. And they didn't do an amateur job of it. They hired Goldman Sachs to falsify the numbers for them. So they did a professional job of it. But right, if you have countries that don't keep their fiscal house in order and you can't help bailing them out, then you've got a time consistency problem, and it endangers the monetary union. So that's the problem Europe has now. So they made a good attempt to tie their own hands. If you read the ECB constitution, it's great. It says we have one goal. The goal is price stability. We don't pay attention to anything else. Fiscal policy, unemployment, we don't pay attention to any of that. We're single-mindedly dedicated. Well, when push came to shove, they started buying Greek government bonds. Yeah.
I have two questions. The first is why housing prices wasn't part of the inflation in the US, because I believe in Israel it is a part of the
Okay.
of the ratio. And the second one is, in Israel the problem we have, and it's picking up where Ziv left, I think, the problem we have is we have to keep a low interest because the flow of foreign money will be too strong and will make it hard to export from Israel. And so we have low interest, but this pushes the housing prices and inflation up. So, I mean, I'm thinking, what would you say is a possible monetary policy for Israel in this situation that we need a higher interest but have a problem doing that?
Well, there are two reasons interest rates could be low. One is there's an abundant supply of loanable funds. So if the rest of the world is putting money into Israel, that's not a problem. That's sustainable, and that makes investment in Israel cheaper. That's great. But if the interest rate is low because the central bank is holding it low, because they don't want so much inflow of foreign funds, if they're holding it below a market clearing rate, then there's creating a mismatch between the equilibrium and the current market rate. So that's a problem. I wasn't quite sure why the inflow of foreign funds is going to cause inflation.
The problem we have is that a lot of the foreign funds come from high-tech and new industries,
Right.
and this is pushing out the old industries from being financial, because the strong shekel from the foreign funds makes it hard to export from other old industries. So I think this is mainly what the Israeli central bank trying to do. I mean,
It's a nice problem to have, actually. It means you can travel abroad at better exchange rates. It's good for consumers. But hopefully this investment in high tech in Israel is going to pay dividends. It's going to be sustainable. It's going to raise productivity in the Israeli economy. But the government can fight inflation without monkeying with interest rates if they pursue a stable monetary policy with attention to inflation. Now, you asked why housing isn't in the price index of the US. They took it out deliberately to lower the measurement of the inflation rate. They put in rental prices, so there's some measure of housing, but it doesn't reflect the asset price of housing. It's a complicated theory, but in principle you should have asset prices in a price index. The hard thing is to know exactly how to weight them. But by leaving them out entirely, we get pretty clearly a bias in the inflation rate that the Fed perceives. And as I said, that's where the extra credit went when the Fed was pumping it in. So if you have house prices, then you have less of a problem of that. One more? No more? Nope.
Have any actual, real, true changes occurred on the economic watch scale in terms of credit abuse? Of, it can go to a area that we're not really watching. So, or the areas that we are watching, whether on a political, banking, legal end, or even just in terms of how economists are looking at it. Are there new scales being looked at going, oh, well, we messed up in the 20s and we messed up in the early 2000s, maybe there's new markers that we're going to put in place to try to watch this?
There's a very entertaining and useful book on financial history called This Time It's Different by Ken Rogoff and Carmen Reinhardt. And they go through different financial episodes where there's a boom that won't be sustained, so it's very much in the line I've been pushing here. And they go through the rationales people gave themselves for why this one is going to be sustained. This is a new economy. We've had a sea change in technology that's going to permanently raise productivity. So all this investment we see is all completely justified. It's not overinvestment. So there's that kind of research, but people forget the lessons of the last recession. And it is a little bit different in the sense that it's a different industry that's enjoying the new investment opportunities. So if you think about it from the point of view of an investor, they have a new investment plan, they go to a bank, and since the bank has more credit from the central bank, they're able to fund everybody. And as a borrower, you don't say, oh, well, my investment's really not going to be viable once the scarcity of credit reveals itself, once the scarcity of savings reveals itself. From your point of view, all you see is that you got your loan approved, and of course you think your project is going to be profitable.
But is there something economists are now watching different than 15 years ago? Or?
Okay. I can't point you to any particular thing. I mean, there was a change back in the 70s when they learned that the money supply had something to do with inflation. Economists started watching the money supply. Those who believe that credit has an important role in feeding booms are looking now at credit measures that they didn't used to pay so much attention to. I can't tell you exactly which ones, but usually the first introduction of that attention comes from the investment community, and then the economists learn which of these indicators is actually telling you something. Okay, thanks very much.